Right. Good afternoon, ladies and gentlemen. I'm Nishani Pereira. I will be the moderator to this session number 7. Although Jani was supposed to do the moderation, unfortunately, due to some unavoidable circumstance, she could not do the moderation. Therefore, I'll be doing the moderation for this session. Firstly, I would like to warmly welcome to this session number 7. Start your own practice and practice management organizing by the Institute of Chartered Accountants for the betterment of basically the practicing chartered accountants. Actually, the main objective of organizing these kind of sessions to give kind of an insight, as well as if you wish to start your own practice, the areas that you could look into, as to give kind of an shed lights about the areas that you would like, that you have to consider, or else the main areas of focus that you have to look into at that time. Up to now, we have organized sessions, 6 sessions, and today is the 7th session that we are going to discuss about the risk-based internal auditing today. For that, we have a well-experienced and educated person who would like to discuss about the risk-based internal auditing. He's none other than Ms. Ashen Jayasekara. He is the Deputy Managing Partner of CA Sri Lanka, as well as he is a Managing Partner for BDO in Maldives. As you all know, he is serving as the Governing Council member to the Institute of Chartered Accountants. In addition to that, he serves as a member of the Corporate Governance faculty, as well as he is the alternate chairman of the Forensic Accounting faculty. In addition to his services to the Institute of Chartered Accountants, he is also a member of the Computer Forensic Global Advisory Board of the Easy Council USA and the Cybersecurity Center of Excellence of SLASCOM Sri Lanka. He is serving as a treasurer of ISACA Sri Lanka as well. As I told you earlier, he's well experienced, as well as the best person to discuss about this risk-based internal auditing. He's a certified internal auditor, as well as a certified fraud examiner and a certified information system auditor. With that, we would like to start the session with Mr. Jayasekara. Before that, I would like to inform you during the session, if you get any question, if you need any clarification, you can post your question in the Q&A chat box, where we will be taking those questions at the Q&A session, and we will try to answer all of your questions at that time. It's over to you, Ashen. You can proceed with your presentation.
Right. I hope you can hear me and see the slides on the screen.
Yes.
So if at any point you cannot hear me or you cannot see the slides, please don't hesitate to let me know. And thank you, Nishani, for that kind introduction. Nishani and I were colleagues some time back. We used to work in the same firm, and I'm delighted to be here today to talk to you on the topic of risk-based internal auditing. So as you know, as you are aware, risk-based internal audits are a very important component of the corporate governance framework in any organization. Internal audits are a necessary part of business. Now, when you take the internal audit function of any company, today you find that internal audits have evolved to the point where their internal audits are designed around the risk management program of the company. So risk-based internal audits is an approach where you focus mainly on inherent risks in companies, and your main objective being of providing assurance to the board that the company is effectively managing risks within, of course, the risk appetite of the organization. So the risk-based internal audit approach has become very, very popular in the recent past. And if you are planning to carry out an internal audit in your practice for an organization, it is very important that you adopt and implement a risk-based internal audit methodology. Because a risk-based internal audit methodology enables you to identify and prioritize risks and develop your audit program, your audit plan, your audit scope, your audit program, taking into account the risk management program in your in the company that you're planning to do the audit. So traditional audits that we used to do many years ago, tended to focus mainly on controls. Right? We used to go to an organization and ask them what are the important controls you have, and then we check, as part of our internal audit effort, we check compliance with those controls. Are they properly implemented? Are they properly designed and implemented? Are they operating effectively in the company? So that's the sort of assurance we used to give when we carried out traditional internal audits. But today, if you are to carry out an audit, you have to start now with the inherent risks, whatever the process or system that you're auditing. And then you have to see whether there are proper controls in place to mitigate those risks. So you don't just look at controls, you take 1 or 2 steps back and you see what are the risks or the inherent risks this company faces. And then you look to see whether the organization has sufficient and appropriate internal controls in place to address those risks. And when you are also looking to see whether the company has proper controls in place to address risks, as a part of this new methodology, you have to prioritize risks, high, medium, low, whatever the classification methodology that you use. You not only you identify risks, you also prioritize risks. And then through this process, you basically provide some sort of assurance to the board that they are properly, effectively managing the risks faced by the organization. So it's a risk-based approach. It enables the auditor, right, to identify risks correctly. And it gives the auditor the opportunity to comment or to provide assurance to the board that the internal controls in place are adequate or are sufficient to address those risks, and the fact that they are well managed is the sort of assurance that you seek now to give. So having said that, I would now like you to divert your attention to what's on the screen. Let me, all right. So as you can see, the need to manage risks in an organization is a very important component of corporate governance. And this has put a lot of pressure on organizations to identify mainly the strategic risks or the business risks faced by these organizations. And through some sort of an audit process, auditors are now expected to comment through their internal audit reports that the organization is effectively managing these prioritized or the significant risks faced by the organization. So there are so many activities in an organization which are involved in managing risks, and all these activities need to be identified, because At the end of the day, all internal controls exist to manage risks. While the responsibility for identifying and managing risks belong to the management, internal audit has a role to play in providing assurance, as I said, that these risks are properly managed through their internal audit reports and findings and the conclusions that they reach. So the internal audit program then, the methodology that you adopt has to be agile enough to recognize, identify and recognize the risks faced by an organization and to carry out the necessary audit procedures to give that sort of assurance. So it is now becoming more aligned. The internal audit methodology, being risk-based, is becoming more aligned with the enterprise risk management framework of the organization. You cannot do internal audits today without thinking about, without getting a good understanding of the ERM, enterprise risk management framework of the organization where you intend to carry out an internal audit. Of course, we all know when it comes to internal audits, in the external audits, of course, you have the statutory Sri Lanka auditing standards that you need to follow. Similarly, for internal audits also, you don't have any statutory mandatory localized internal audit standards, but there is this organization called the Institute of Internal Auditors. This is based in the USA, headquartered in Florida, and this organization back in 2009, right? They introduced this framework called the International Professional Practices Framework, which you can see on the slides. What they introduced initially is given on the left, and what it has evolved into is given on the right. So this framework consists of a mission. Today, when we do internal audits, we must be aware of the overall mission as to why we do an internal audit. And this framework also basically provides guidance on how to do an audit, the characteristics that an internal auditor or the internal audit function should possess. So you have what you call mandatory guidance and recommended guidance. And under the mandatory guidance, you have the standards, international standards on the professional practice of internal audit. That's how it is called. And you have a definition. They've gone on to define what internal auditing is. And then you also have a code of ethics along with a set of core principles. So if you are planning to do an internal audit, I suggest my sincere recommendation is that you become familiarized, right, with this framework. It's called IPPF. That's the acronym. And you need to Google this, download it, and go over the guidance provided by this framework. So the mission is to enhance and protect organizational value. As you can see, what does value mean? Value is at the end of the day stakeholder value, right? It's not just the shareholder value, the market capitalization. The organization has many stakeholders, from employees, suppliers, the wider community at large, the regulator, aside from the shareholder. So you need to ensure that you protect, you recognize, and you protect the values of all these stakeholders through your audit. And it also goes on to mention that it must be risk-based. And you see that in the mission itself, it says, when you do an audit, it has to be risk-based and objective. Objective is something, of course, we all know. Objective means when we do any sort of assurance work, we have to be unbiased. We should not be influenced by others. So this is a term we are quite familiar with. But what does it mean when they say we must be risk-based? The advice that we give, the insights that we give, the assurance that we give needs to be risk-based. That means from the point in time where we develop a scope for internal audit, we develop a plan, a program, we draft our internal audit reports, we present our internal audit reports. All those phases today needs to be risk-based. What divisions do we audit first? Selection is based on risk. What area should we cover in the scope? That selection is also based on risk, right? How should we present our findings? That is also based on risk. I mean, we need to pay more attention to our high-risk findings rather than the low-risk findings. So this is now incorporated in the mission itself. And then if you go on to the definition of internal auditing, here again it says that the main function, right, the main function of an internal auditor is to add value and improve the operations. It's not mainly focusing on financial areas. We are supposed to add value to operations. Financial areas are covered by the external auditor. And how do we add value to operations? Are we to comment on efficiency in production? Are we to comment on productivity? Not exactly. In the definition, it says, rather than looking at all that, the way we add value to operations is by looking at 3 areas. And to those of you who have experience in internal auditing, the term GRC, governance, risk and control, GRC, you are familiar with it, you have heard of it before. So how we add value through our audit to an organization is we have to improve the effectiveness of GRC. When we do an internal audit, we have to evaluate and improve the effectiveness of the governance mechanisms. We have to evaluate and improve the effectiveness of risk management, that is ERM. And then we also have to evaluate and improve the effectiveness of controls. So here again, you see the word risk management. So in the mission you saw it, now you see it in the definition, and I can tell you, it is also there in the standards. Wherever they talk of internal audit planning, the way to carry out an audit, the words risk-based precedes planning, scoping, drafting a report, presenting. You find those words always incorporated into those sentences and standards. So I just wanted to share with you the mission and definition, just to show you that indeed, even though this definition was introduced way back in 2009, right? The definition has more or less remained unchanged throughout this 13 years. But today only, we tend to focus more on the fact that it has to be risk-based. So you have a set of principles also given in the IPP framework, which I'm not going to go into. We all know this. You can go through it at leisure. So the Code of Ethics also highlights the fact, the Code of Ethics issued by the IIA, which is mainly applicable to those who are members of the IIA or who hold certifications of the IIA, and also it is applicable to those who have in their own internal audit charters in the organization state in their charters or SOPs that they will carry out their work according to the IIA standards. So in the given scenarios that I have mentioned, you have to ensure that you abide by what is stated in the Code of Ethics. So they say here, the the internal auditor shall perform internal audit services in accordance with the standards. And when you go through the standards, it says that it must be risk-based. The planning must be risk-based, the reporting must be risk-based, the actual carrying out of the audit work must be risk-based. So how it is defined by the IIA? It says it's a methodology that links internal auditing to the risk management framework of the organization, that is the ERM framework. So if you are going to do an audit, you've got to ask, do you have an ERM framework? And get a very good understanding of this framework, how it operates in the organization. And as I mentioned before, right, as I mentioned before, it says here that the internal audit should provide assurance to the board that the risk management processes are managing risks effectively, right? So that's our main objective. So now when we issue reports, do we say in our reports whether the risk management processes are managing risks effectively? Maybe not. And if we are not stating in whatever area that we audit, document, accounts receivable, accounts payable, in whatever area that we are auditing, if we are not stating that the risks in the area that you audited are being managed effectively, it basically means that your internal audit is certainly not effective. It doesn't meet or fulfill the objectives given by the IIA in terms of how an audit should be done. So before we get on to and see whether we can do a risk-based internal auditing, we first need to see whether the organization has a risk management framework. Many audits that I do, that we do, that most of you do, do you ask the management, what is the ERM framework like? What is the structure? How do you identify risks? How do you manage them? How do you rate them? Do you have a risk management, what do you call it, reporting framework? You have a risk register. If you are not, now you have to start asking these questions. If you want to adopt or implement a risk-based audit methodology when you carry out audits. So in some organizations that we audit, yes, there is an ERM framework. In some, there is no ERM framework. So our strategy in how we plan out the audit differs in many ways. For an organization which has a mature ERM framework to an organization that does not have a mature ERM framework, the strategy differs. So what sort of an audit strategy should you have depends on the risk maturity of the organization. So there are a lot of advantages in adopting a risk-based audit methodology, because through that, if you adopt it, you can comment on whether the management has identified, whether it has assessed and responded to risks above and below the risk appetite. You can also comment on whether the risk responses, once you identify a risk, you need to have risk response or some sort of a mitigation action to control that risk. And you can also comment on whether these risk responses are effective. You can see you have the inherent risk, you put in a control, then what is left is the residual risk. And that residual risk needs to be within the risk appetite. You can comment on that, because if the residual risk is not within the risk appetite, then you have to suggest further controls to bring it within or to an acceptable level. You can also comment on how the organization reports to up the hierarchy to the senior management and to the board on how it manages risks at an operational level. You can comment on whether risks are properly identified and classified. So whatever department you audit, now you have to start thinking about the way risks are managed in that department and ensure that you comment on it. through your audit. So there are several stages in risk management. You can see the first stage is assessing risk maturity, right? Then second stage is preparing the audit plan, and the third one is carrying out individual audit assignments. So the first stage, as I mentioned to you before, entails getting a very good understanding about the risk maturity. You go to an organization and they don't have a documented ERM policy, that means they may have a practice but not board approved policy. Then you have to note that fact. You have to identify and obtain an understanding as to whether they have a methodology to classify risks that they identify based on probability and likelihood. There are various classification methods. Do they use such a method? What sort of risk registers do they use, or do they not have a risk register? What sort of risk reporting is done? So based on a checklist, right? Based on a certain checklist where you ask a lot of questions, you can get an idea. Is this organization mature in terms of managing risks, or is this organization very weak? They talk about risk, but they have nothing documented. So you got to identify the exact state of the organization in terms of maturity on ERM. Then the second stage would involve planning out. So you have to identify all the areas that need to be audited, the audit universe, and then carry out the audit. So this is a snapshot. I just thought of putting this slide in just to give you an idea about various phases that you have to follow if you are told to develop a risk-based internal audit plan, right? So this is, I think I have about half an hour, so I will just very briefly touch on this. So the first step is to go through the strategic plan, business plans of an organization, and find out what the organization wants to achieve, the strategic goals, the strategic objectives of the organization, right? What does the risk appetite statement of the organization look like? You have to understand the business. Even in an external audit, there is a standard for this. SLA US 315, I believe. Similar to that, you've got to get a very good understanding, apart from going over the strategic plans, business plans, risk appetite statements of the organization. You also have to get a very good understanding of the entity and the surrounding, or as they call it, the environment, regulatory framework, the political, economic, legal environment of the organization. You've got to get an understanding of the various products, services sold by the organization, geographical locations in which it operates. So when you know all that, when you know what the organization is trying to achieve, you know what the risk appetites of the organization are, and then when you have a proper understanding of the business and its environment, then you can move on to prepare the audit universe. So what is the audit universe? Audit universe is all the audit units that are auditable: procurement, HR, marketing, operations, factory, accounts receivable, accounts payable, inventory, taxation, it goes on. So you've got to identify all these units, auditable units, they call it. And then you got to, once you identify all these auditable units, of course, you can't, no company has the resources to audit all these units within a given year. So now you have to, what you call, filter, select the high risk auditable entities, units. Some units like HR may not be that important. Marketing may not be that important. Inventory might be a high risk area. So how do you do this? How do you identify which entities are more important than other entities? Which entities or units pose a greater risk to the organization. Therefore, they need to be audited first. Well, we have to have a risk framework for this. That is where the risk register comes into use. All departments must have a risk register, and then the risk register would have all the risks identified. Then the risks have to be prioritized, categorized first, evaluated, assessed, categorized according to some recognized classification system, and then prioritized. In procurement, these are the processes which are high risk. In accounts receivable, these are the processes that are high risk. In overall department-wise, you have to identify which departments pose a higher risk than other departments. In a department, what are the high-risk processes? Put that aside. Holistically, what are the departments which pose a higher risk? So to do all this, obviously, you need to document. The risks faced by the organization at a strategic level and then at an operational level. You need to assess the control environment. We all know of a famous framework called the COSO framework. Based on that, each department, you can get an idea about the control environment. So risk registers are very important in this. Some of the work that we do, our first step is to prepare a risk register, and from that, you can formulate your audit plan. Right? So when you know which departments pose a greater risk, that is, if things go wrong in that department, the chances of you achieving the objectives, the strategic goals, those departments will pose a greater threat or prevent or hinder the organization from achieving its strategic goals. So you have to identify and then have some sort of mechanism in place so that the high risk departments will be audited maybe annually, the medium risks within 2 years, and the low risk entities or units will be audited within 3 to 5 years. So as I mentioned earlier, you need to assess the risk maturity, right? Then you need to report to the management and to the audit committee about the risk maturity and agree on audit strategy. So you need to talk to various people. You need to, if you want to find out about the risk maturity of an organization, it's not something you can do. It's not desk research. You've got to go out there. You've got to speak to the heads, the CEOs, the boards, the directors, and all that. Go through numerous policies of the organization, specifically the ERM policy and any ERM report or related reports. And then you've got to go through the risk registers. And once you do all that, go through the objectives, the processes, and all that, then you can come to a conclusion as to whether the organization, what level of maturity is there in that organization. So to the risk maturity is also classified in a certain way, right? So what are those terms? Here you can see the best are called risk enabled, the second best risk managed, risk defined, risk aware, and risk naive. So if you are, once you assess the risk environment in the organization, if it is risk aware or risk naive, right, then that obviously means that the organization does not have a documented ERM process in the organization. So it's very difficult to do a risk-based audit if the organization itself has not properly documented its risks, right? If it is risk defined, that means they have some sort of ERM board approved ERM policy, and your job is a little easier. Risk managed and risk enabled means that in terms of maturity, the organization is very, very mature. So you would want to, so if you are going to carry out an internal audit, right, for a risk aware or risk naive organization, then you will not be able to do the sort of assurance based internal audit. It will be more of a consulting assignment where you will tell the management and the board and make recommendations on how to improve ERM processes. It's more of a consulting role that the auditor will play. But if it's risk defined, risk managed, or risk enabled, then that means now the organization has documented all its risk related processes, mechanisms, systems. Then what you have to do is you can do a more assurance based internal audit. Then it's a case of just checking for compliance. Your job is easier. So I covered these two slides already. Let me just, so after you classify the risk maturity of the organization into one of those 5 that I mentioned, then you've got to go to the audit committee and say, okay, this is where it is placed in terms of maturity. And this is the sort of strategy. We cannot do assurance-based internal audits. We can only do a consulting audit, not an audit, consulting assignment. And we will advocate, right? We'll be an advocate and we will make recommendations as to how the organization should improve its risk management processes. Right? You cannot do an assurance-based assignment to the extent that you would want to if the organization is risk naive or risk aware. So there are a range of strategies, as I mentioned before. These are a snapshot of the strategies. As you can see here, if it's risk naive or risk aware, all you can do is you can maybe provide assurance on the control processes, but you cannot provide assurance on the risk management, right? So you're now being a consultant here. You're being a consultant. You can tell the controls are working or effective, but you cannot link it properly to the risks faced because the organization has not documented its risks. It does not have a proper ERM process, right? But if it has documented its risks in the risk register and the controls also mapped, then you can provide assurance, not only control processes, you can provide assurance on the risk management processes as well. So there are various strategies that you need to adopt, and what you need to keep in mind is your strategy changes based on the risk maturity of the organization. So those are some of the slides that I wanted to go through with you. I hope I was able to give you a snapshot or a brief overview of what a risk-based audit methodology looks like. So if you have any questions, maybe you can communicate it to Nishani and then she will pose it to me.
Okay, thanks, Ashen. It was a very interesting presentation. Thank you very much for sharing your experience as well as sharing your knowledge with our participants. Till they pose some questions, let me ask 1 or 2 questions from you. One is you are discussing about the IIS, International Internal Auditing Standards. Is it mandatory for us to apply IIS in internal when we are doing any internal audit?
Well, it's like this. They are best practices. So even if you are a member of the IIA, then of course every time you renew your membership, you have to tick this check this box saying that you will follow the IIA framework, which includes the code of ethics and the standards and so forth. So, and if you are holding a certification like certified internal audit, you're expected to follow the standards and the code of ethics. So in that sense, it is mandatory. But if you are working in an organization, I mean, let's assume it has no CIAs or members of the IIA. But if you've adopted the practice and you've stated in your charters that you will carry out the audits according to the IPP framework, then of course you are expected to follow and comply with the internal audit chart in your organization, or it could be documented in an SOP. But if that is not the case, right, there is no mandatory requirement at all. There's certainly no statutory requirement. But as a best practice, it is, I think, essential that we evolve to the stage where we follow the standards so that we can, provide effective input to the GRC, governance, risk management, and control processes of an organization.
Right. Okay. Thank you. You were discussing about this ERM framework and the matured ERM framework and not matured ERM framework in companies. How about your experience in Sri Lankan companies when you were carrying out internal auditing about this maturity, about the ERM framework? Are they matured enough, or how about the percentage of the companies based on your experience for the matured ERM frameworks?
Yeah, so it all depends on whether they are listed or not. Even if they are listed companies, it depends on what sectors they operate in. Sectors generally like banking, finance, insurance, telecom, those sort of tech sectors, due to the influence of the regulator and to the fact that they have sometimes board level subcommittees called integrated risk management committees. It is essential that they have an ERM framework in place. But if you look at some of the conglomerates which are not operating in those sectors, the large conglomerates, some of those companies, yes, do have ERM frameworks in place, but they are not robust enough. They just identify maybe strategic risks at a very macro level. But ideally, what we would like to see as internal auditors in an organization is that apart from the strategic risks, you would also like organizations to document operational risks, because when we do audits, operational risks are also important, right? For example, risks like fraud risks, IT risks, they're also important. And if that has already been done by the organizations, our job is so much easier. So it depends on the sector. I mean, family-oriented companies, you would not see risk registers, but highly regulated companies, you see risk registers, and then to develop a plan, a risk-based audit plan based on a risk register is so much more easier than auditing in a company where it does not exist.
Right. It seems it's kind of a regulation driven. Right. Yeah. We have one question in our Q&A. It's given time constraints or cost budgets, would you perform additional compliance tests? That means payable, receivable, in addition to high risk identified.
Yeah. So I think I get the gist of what the attendee is asking. So it's like this: when you have your audit universe with so many auditable units, you need to first identify which units pose the greatest threats to the organization, in which divisions does risks arise, right? Which are the most what you call vulnerable divisions, where risks arise which could lead to the organization not achieving a strategic goal or objective. What sort of divisions, if there are kind of issues, would take you out of the risk appetites, get you to exceed your risk appetite. So whatever said and done, those high risk divisions need to be carried out first, right? Within every year it has to get covered. Otherwise, you're not providing the kind of assurance that the board requires you to provide. Then apart from that, I mean, it depends. If you identify, I cannot see the question. Where is it? Where is the question? Yeah, apart from that, there could be other areas as well. It depends. If you mentioned, I think, accounts payable and some other areas. So if accounts payable is not a high risk area, still you may need, even medium risk areas need to be covered within a span of 18 months to 2 years. So, but the question is, even within accounts receivable, you don't have to cover everything. You can have certain processes which pose a higher risk than other processes within accounts payable. So maybe you can cover accounts payable covering those high risk processes within that function, right? So you can make it risk based to that extent.
All right. Ashwin, we have another question. What type of risk do internal auditors focus more, process level risk or business level risk, in applying the risk-based approach?
Yeah, so the most important, when you take an organization, there are different types of risks, but the most important risks to an organization are the strategic risks. Those are the risks which impede the organization from achieving its strategic goals. So those are the risks we need to address first, because if those risks materialize, what it means is that the organization will not achieve its strategic goals, which will be a problem for everyone. So let's focus first, identify and focus first on what those strategic risks are. Then we move on to the operational risks, which is more process driven. Now, operational risks are risks which arise from people, processes, and systems, right? So those risks are also important. An operational risk can give rise to a strategic risk. So my advice is, first you try to take care of the strategic risks. You try to see what controls are there to control the strategic risk and see whether they are operating effectively or not first, before you get on to operational risks. But strategic risks, operational risks, compliance risks, these are all intertwined, right? An operational risk at a departmental level can result or be an input to a strategic risk, right? So all these risks to some extent are linked. That is why when we go to auditor department, we try to see how does this department affect the strategic risks or the strategic goals. So at the end of the day, we all know, we all carry out processes. So some processes could result in strategic risks. Some processes could result in operational risks. So processes are also linked, operations are also linked in some way to strategic risks. But let's start with the strategic risks first and see what processes, what operations affect those. Because strategic risks come from outside also, a new competitor arising, right? Lack of US dollars, unable supply chain risks. These are strategic risks. But at operational level also, if you don't manage it properly, it can give rise to a strategic risk. So start with the strategic and then move down.
Okay, right, thanks. The other question is, as an internal auditor, can we allocate risk score for not achieving the budgeted financial targets of a particular business unit?
Yeah, so you have, so when you do an internal audit, there are two sides. One, of course, is performance. Other one is conformance, right? So we cannot do a compliance-based conformance audit. We also have to balance, have a look at the performance. It's like, it's something like this. So let's assume you have a bank and you have a branch in Borella, and they have a fixed unit, fixed deposit unit. So their job is to canvass for FDs. Now let's assume, right, when you do a conformance internal audit, you would check to see whether for all FDs, whether an FD mandate has been obtained, it is signed off, completed properly, approved by the manager and all that. The certificate is issued. So you will look at a whole host of internal controls related to the compliance aspect or conformance aspect, compliance with the laid down policy or procedure, right? And that could be perfect. But let us now assume that due to some reason, in that particular branch, the customers or the FD holders are not renewing their FDs. They are coming in prematurely withdrawing their FDs. So when you look at performance, and if a performance-related KPI has been given that the branch must achieve a fixed deposit renewal rate of 90%, and you found in your audit, so this is a performance statistic, that the FDs are not renewed. The customers are coming in droves and withdrawing their FDs prematurely because the interest rate has gone up and they can find better rates in treasury bills and bonds. Isn't that a strategic risk? Isn't that a liquidity risk? It is. So a performance-related matrix can lead to a strategic risk for the organization, right? Your compliance-related work would have been the finding would have been, or the conclusion would have been, everything, the documentation is perfect, other than for the fact that FD holders are coming and withdrawing their cash. So banks can just collapse if all with FD holders come and prematurely withdraw. So, as I said, identifying KPIs is important. Looking at budgets versus actuals is important, and if you feel that non-achieving a KPI could lead to a strategic risk, a liquidity risk, a sustainability risk for the entity, shouldn't you highlight that as a high risk? You have to. Performance must be taken into account. It's not only about conformance.
Right. Okay, Ashwin, the next question is, it's relating to the coding level internal audit. The question is, how do you do the coding level internal audit? Is it only by test data or any other method?
Yeah, coding level internal audit, I believe, is a situation where a client comes to you and tells you, we have a software program and we want to see whether the coding of this program has been done properly. Now, we all know we all know that this is a little bit outside of the traditional internal auditor. We are no experts in coding. So when a program is being coded, there are certain standards that you have to follow, right, related to quality assurance and security and so forth. Coding also has to be done, like we have the internal audit standards. The coders also have certain benchmarked guidelines and coding practices, best practices that they need to incorporate, they need to think about and implement when they do their coding. So the second aspect is whether the program delivers what it was intended to deliver. You could have a situation where it is coding has been done, but it is not meeting its functional requirements, or security-wise, it has not been built to meet the security standards. Hence, it's a threat or a vulnerability to the organization. So here is a situation. I have been asked sometimes to do coding reviews, and I've declined it. Or in certain cases, I've accepted it. But you need to obtain. When I say I accepted it, I got an expert on board who has the necessary software tools to do a coding review. Because in some cases, these clients want to know this was the original code, but is it what it is in the production environment? I mean, someone could have messed around with the code, and what is in the production environment may not be the original code. So you can do a code comparison. You can have someone look at the code and tell you whether the coding methodology that was used is good. It exposes the company to any sort of vulnerabilities. So you need an expert. As an internal auditor, sometimes you need to know where your expertise ends and when you should take on the services of an expert in that particular area.
All right, Ashwin. The next question is, it's relating to the listed companies who uses the certified internal auditors to do the risk-based internal auditing. What his question is whether the audit committee is taking those the results or the outcomes of the internal auditor properly, whether they are giving high priority, as well as whether they do kind of follow-up actions to the findings that the internal auditor has raised. How about your experience, Ashwin? How about their responses to the observations?
So it all depends, as I said, on the industry in which the company is located. I mean, if it's bank and finance, it's highly regulated, and you've got to ensure that your governance responsibilities are properly discharged as per maybe central bank directives. Some audit committees that you go to are just a tea biscuit affair. You have a cup of tea, you mention a few risks, findings, and then you come off. So the audit committee chairman, he also plays a very important role. It depends. Certain audit committee chairman will take on the management quite independently. Key findings where the management is also a bit hesitant to adopt or to implement certain recommendations by the management, the audit committee chair will what you call steamroll through and ensure that it is being implemented. So it depends on the caliber and the expertise of the audit committee chairman and the ability of the audit committee chairman to independently enforce certain recommendations made by the auditor. Because sometimes in reports we do see areas where based on the management comment given, there may seem to be what you call a disconnect or where the management may not want to implement certain recommendations. But if you have a good audit committee, they will independently look at the observation, and if they feel the recommendation needs to be implemented, they will tell the management to do so. So it depends, the tone at the top, the caliber of the audit committee members, and the management style. All these play a kind of a it's a cocktail, all factors need to be taken into account. But at the end of the day, what I feel is that especially the audit committee, the chairman and the other members need to very forthrightly, without any fear, look at issues independently, and if they want something done, something implemented, they got to direct and instruct the management to do so.
Right. I think the next question is also relating to the answer that you have provided. He's asking about the independent directors in an audit committee, whether they are raising the voice in relation to the internal auditors' points, as well as is it showing kind of a poor corporate governance practice in Sri Lanka and the independence of the directors?
It's like this in Sri Lanka, like anywhere else. Though you call yourself an independent director is also appointed by the majority shareholders. So the majority shareholders appoint the directors, the executive directors, as well as the independent directors. And if the independent directors go against the will of the majority shareholder, I mean, you might be removed, right? The corporate governance frameworks are designed as such. All you need to remove a director, independent or otherwise, is just a simple majority at an AGM. So how independent can you be? Can you be independent to the extent that you don't mind losing your position and perks, right? So these are inherent weaknesses in corporate governance frameworks, not only in Sri Lanka but worldwide. But independent directors at the end of the day have more responsibility in terms of governance than other directors. And that's why they head the most important committees like nominations, audit, risk. And the central bank also wants an independent director to head these committees. And because of that fact, they need to understand that they need to properly discharge their responsibilities independently. They bring in that independent viewpoint to deliberations. So that has to be done properly, right? So it's an inherent risk. Though you're independent, truly you're not independent.
Right. That's great. Okay, we have a few more questions. I will take them quickly with the interest of the time. This is an interesting question. Are internal auditors subject to legal liability?
When you do an external audit, You can't limit your liability. You don't have a limited liability because your powers are statutory. It is derived from a parliamentary act. The management cannot refuse to give you any documents, or you have all the power in the world given to you by a parliamentary act to demand for information or access to people. If that is not done, you have the right to express a modified audit opinion. But if you are an external auditor, we all know, in practice, we have that liability clause, right? We have a liability clause which says the liability is limited to the audit fee. So if the management signs off on that, and due to some sort of negligence, the management wants to sue you, obviously this contractual liability, this contractual clause will come into play. So I don't think in Sri Lanka they've actually had any cases where they were able to prove negligence, because you have to prove cause and effect. What has happened is due to the auditor's negligence, and it's very difficult. We have the Roman Dutch law and all that. Even for external audits, we haven't seen it, isn't it? So for internal auditors, I suppose we have to be careful. Gross negligence is what we have to avoid. That's why audits have to be risk-based. But we contractually limit it through the engagement letter. On the legal side, of course, I'm not quite conversant. I've read about it, but I've yet to come across a case where the audit has been sued. It has been the other way about. The auditor sued the client, right? Yeah. That has happened, not the other way about. It's very difficult to prove negligence.
Yeah, it's correct. It's very difficult to prove the negligence. It's up to the company to cover their liability through their contractual terms, I guess, through the letter of engagement.
Yeah.
Right. There's an interesting question. This is relating to for their practice, Ashen, I guess. How to price the internal audit assignments? Is there any approved guideline in place?
Yeah, so there is no approved guidelines. There is a kind of a, I think the Institute of Chartered Accountants issued a fee structure, charge out rates for partners and managers and so forth. So I suppose you could get your hands on one of these documents and then estimate your audit based on the charge out rates. I mean, 12,000 for a partner like that. There's a charge out card issued by the Institute a few years ago. This was, of course, to prevent undercutting, I believe. But you've got to get hold of this fee card or charge out rate card, which was issued to all audit firms, I believe. And then when someone asks you to quote for an assignment, look at the duration, look at the time spent for each designation, and you have to propose a fee as such.
Yeah, it's available in the Institute website. You can locate that document. From that, based on the time that you are going to incur to the internal audit, you can decide the price for that. The next question is, in organization can use the COSO framework and implement it? How it will reliable and practical in Sri Lankan context?
All right, so the COSO framework is the foundational framework for all internal auditors. If you do not know or understand the COSO framework, you cannot do a proper internal audit. So the COSO framework, when an organization looks to develop, formulate the internal controls, they need to adopt this model. They need to look at the framework because it looks at the organization talks about 3 levels of objectives. You have, can't exactly remember, I think strategic, reporting objectives, strategic objectives, and compliance objectives. And then it has, in another aspect or dimension, it has the types of entities at firm level, unit level, functional level, like that. And then it talks about 5 key principles where you have the control environment, risk assessment, internal controls, communication, and then the monitoring. So when you study the internal controls in a department, you've got to look at all 5 of these aspects: the control environment, the risk assessment. Based on that, you have control activities, then the communication, and finally the monitoring. So yes, you need to look at all this. So there is a very interesting question here. Do you see BDO Sri Lanka got a bright future with government of Sri Lanka? Yes, BDO, irrespective of the government, always has a bright future. But then again, you know, with all these external factors, but the biggest problem would be the economic factors rather than political or regulatory. So,
right. It's common for all the businesses with the current context.
Yeah. So we've got to learn to live with all governments.
All governments. Yeah. We have one more question, Rashin. Let's take that also.
Last one.
Yeah, that's the last one. Internal auditors should be carried out in accordance with the mandate or a scope given by the client, either top management or the audit committee. Sometimes they may not want internal auditor to focus on strategic level risks. How do you respond to it? How about your experience on it?
Yeah, so internal audits are given not by the shareholders. It's the management and the board that decides on what areas need to be covered, what should be the scope. So as an internal auditor, you work for the director board, not the shareholders. You don't have an external responsibility as such, but you've got to be a little careful. There are various, you don't know where questions might be asked. The SEC might ask you certain questions. The regulator might ask you certain questions. But what you need to remember is if you are told not to look at strategic level risks, then if you are a good internal auditor, you will communicate that to the management and say, since we are not looking at these risks, these are the procedures we cannot do. These are the sorts of assurances we cannot give. Because as you can see, the methodology itself tells you that you need to start your work with the strategic risks, right? So if you cannot do that, we don't want you to express some sort of assurance when you actually cannot express it correctly. So the scope of work is always determined not by the management. The management gives an input, but it's determined by the board. So if the management tells you not to do it, you've got to ask the board. Management is saying, so should we? But if the board audit committee also tells you not to do it, then if you're auditing a certain area, you've got to communicate, right? This is a scope limitation of sorts, but not a scope limitation. This is an area that you're not supposed to touch. So if that is the case, you must be very vocal, right? Not argumentative. You've got to tell, okay, since you're not looking at this area, these are the audit procedures that you cannot do, and these are the assurances that you cannot give. You cannot tell that all these things are working properly if you do not have. You cannot properly say whether the controls are effectively controlling the strategic risks if you don't know what the strategic risks are. So that sort of a disclaimer needs to be built into your report. Otherwise, you'll be giving a kind of a false assurance to the board. As long as they know if you're not looking at a certain area, you cannot comment on certain things. All right.
All right. Thank you very much. You have taken more than 10 questions. Thank you very much for your time, as well as thank you very much for sharing your experience and giving advices to the people who would like to start risk-based internal auditing in their practices. And right, I think your presentation would give add value to their practices as well. Thank you very much. And I would like to thank our participants as well. We are looking forward to see you in our next session as well. Thank you very much, Shah.
All right, thank you. Thanks a lot.
Okay.